Ever heard of the saying, buy once, cry once? Well, today we're diving into the investment philosophy of Terry Smith, the British fund manager who's turned heads by achieving over 500% returns in the stock market since 2010. Imagine investing like you're buying a car, and one that doesn't end up in the junkyard. Stick around as we explore Smith's strategies for investing in growth without the tears. If you're new to the channel, don't forget to hit that subscribe button and ring the notification bell so you never miss an update. Takeaway 1. Great car, great choice. Alright, buckle up because we're about to hit the road with some investing wisdom. Picture this. There's a professional gambler named Alex Bird, a real character in the betting world. Now, Bird had his nifty strategy back in the day. You see, during horse races, when it got down to those nail-biting photo finishes, he'd close one eye. Why? Well, it turns out that the horse furthest from the crowd looked like it was sprinting, creating an illusion of being the winner. But guess what? Bird had a savvy move of dismantling this illusion by simply shutting one eye, a trick that led to him making some serious money. Now, let's relate this to Terry Smith's investing style. Smith's advice? Don't jump into the market blindfolded. Instead, wait until you know who the real winners are. It's not about just any car. It's about picking the top-notch ones that'll take you on a smooth ride for years to come. Smith guides us on how to spot these gems. Look for high profit margins, solid return on assets, and companies expanding their market shares. It's like being in a car showroom and knowing exactly which wheels are going to give you the best mileage in the stock market journey. So, fasten your seatbelt as we cruise through the art of recognizing quality companies. Takeaway 2. Don't pay extra for unnecessary gadgets. Let's talk dividends. Are they like those fancy but somewhat pointless TV screens you find in the back seats of cars? Terry Smith seems to think so. Now, don't get me wrong, dividends can be a nice perk, like having a mini entertainment center on long road trips. But here's the kicker. Just because a company doesn't pay dividends doesn't mean it's a lemon. In fact, Smith argues that reinvesting earnings back into the business can actually rev up your returns in the long run. So, while your buddy might be all about those dividend payouts, don't let them steer you off course from what really matters, the true value of the company. Think of it like this. You wouldn't buy a car just because it has some flashy gadgets, right? Well, the same goes for investing. It's easy to get distracted by dividends, thinking they're the be-all and end-all of a company's worth. But Smith's advice? Keep your eyes on the road ahead and focus on the fundamentals. After all, it's the growth potential and financial health of a company that truly determines its value, not just whether it dishes out dividends. So next time you're tempted to chase after those dividend payouts, remember to stay grounded and prioritize the real engine driving your investment success. Takeaway 3. Wait for the discount. Alright, let's talk about the magic of patience in the wild world of investing. Picture this. You're eyeing that sleek new car, but instead of rushing in at full speed, you decide to hang back and wait for the right moment. That's the name of the game with Terry Smith's strategy, waiting for the perfect opportunity to pounce on quality companies at a discount. And trust me, it can make all the difference in turbocharging your portfolio. So why rush when you can cruise and score a sweet deal? Now imagine this scenario. The market starts to panic, sending prices plummeting like a roller coaster in free fall. Sounds scary, right? But hold on to your seat because in the midst of all that chaos lies an opportunity to snap up those top-performing stocks at bargain basement prices. And it's not just market panics that can pave the way for discounted deals. Even a company's quarterly results falling short of expectations can send its stock price on a temporary nosedive. So buckle up and get ready to navigate the twists and turns of the market, because with a little patience, you just might score that dream investment at a steal. Takeaway 4. Don't let the paint job fool you. Alright, let's dive into the nitty-gritty of company analysis, because hey, looks can be deceiving, especially when it comes to earnings. Think of it like this. You're eyeing a shiny, freshly painted car on the lot, but what's lurking under the hood could tell a completely different story. That's where Terry Smith's advice comes in handy. Instead of just glancing at those earnings per share and relying solely on PE ratios, it's time to pop open that hood and take a closer look. By digging into the free cash flow yield per share, you're getting a more robust measurement of a company's financial health, much like checking the engine of a car to make sure it's running smoothly. So, why is free cash flow yield per share the real MVP of financial analysis? Well, it's simple. While earnings can be easily manipulated, free cash flow tells you the cold, hard truth about a company's ability to generate cash after accounting for expenses and investments. It's like getting a sneak peek under the hood to see if everything's running as smoothly as it seems on the surface. So, next time you're sizing up a potential investment, remember to look beyond the paint job and focus on what really matters: the solid financials that'll keep your portfolio cruising along smoothly. Takeaway 5. No car is a true all-rounder. Alright, let's shift gears and talk about why no stock is a one-size-fits-all solution. Think about it. Just like you wouldn't take a sports car off-roading or expect a minivan to win a drag race, each stock has its own strengths and weaknesses depending on the market conditions. It's tempting to chase after the hottest trends or the latest fads, but as Terry Smith wisely reminds us, that can often lead to a dead end. Instead, it's all about sticking to a solid investment process that's tailored to your goals and risk tolerance. So, before you hit the gas pedal and go full throttle into the next big thing, take a step back and evaluate whether it's the right fit for your portfolio. Now, let's talk about the importance of playing the long game. Sure, it's exciting to see your investments soar in the short term, but as any seasoned investor will tell you, success isn't measured by just a few laps around the track. That's why it's crucial to evaluate investment strategies over a full market cycle, taking into account both the bull and bear markets. By keeping your eyes on the road ahead and resisting the urge to make knee-jerk reactions based on short-term fluctuations, you'll be better equipped to navigate the twists and turns of the market and come out on top in the long run. So remember, while no stock may be a true all-rounder, with a sound investment process and a patient approach, you'll be cruising towards your financial goals in no time. And there you have it, the investing wisdom of Terry Smith condensed into 5 key takeaways. Remember, leaders in their industries, dividends, strategic patience, looking beyond earnings, and a steady investment process are your tools for success. We appreciate you being a part of Wealthway today. We're dedicated to helping you achieve financial success, and we hope that you've gained valuable insights from this episode. If this video resonated with you, please give it a thumbs up and consider subscribing to stay in the loop for our upcoming content. If you have any questions or want to share your experiences, don't hesitate to leave a comment below. Until our next encounter, continue on your journey to financial prosperity, because here at Wealthway, we're confident that your wealth is well within your reach.